Well, hello, everybody, and welcome to the Wealth Builders Investments 2023 Economic Outlook. I'll tell you, you are in for such a treat with this webinar, and we're so grateful that you chose to join us. You're going to be hearing from our CEO, Billy Epperhart. Billy, do you want to say hi to everybody?
Hello, everyone. Looking forward to this time together today.
And Chad Franzen, who is the CEO of Wealth Builders Investments and our certified financial advisor.
Hi, everyone. Glad to be here.
So this is going to be a very informative webinar, and I think all of us are wondering, my goodness, what is in store for 2023? And these guys have got some great information that's really going to position you to be able to go into the new year with confidence and some guidance on what to watch for, maybe some opportunities that you can take advantage of. And I want to just remind you that this is an interactive webinar, and we're going to be saving about 15 minutes at the end of this for questions and answers. So you can go ahead and enter the information that you would like answered in the chat section or in the Q&A. And if you are joining us on Facebook, you can enter the question in the comment section. We just encourage you to. We'd love to hear from you where you are joining us from so we can give you some shout outs. And we always like to find out how many countries are represented in these webinars. So we're ready to get started. And Billy and Chad, I'm going to turn it over to you.
Well, we want to welcome everyone, and we're going to start off here. I think Chad and I have talked, and we're going to start off just showing you some graphs that most of you haven't seen. And we're not going to spend a ton of time, and Chad's going to jump in here with me as we talk about these. But one of the first graphs I want to put up is really kind of showing us where we are with asset prices compared to what we call the gross domestic product. And then we're taking the asset prices and we're comparing that to our interest rate. So as we put this graph up, you can see that the yellow line that's on the graph is actually interest rates. And I just want to point this out because I'm sure we have people from all over the world watching, Chad. And so interest rates, when we talk about interest rates, these specific rates are United States interest rates, but they're very similar all over the world in the same time frames, except in some cases they're a lot higher in recent years in some of the other developing countries. But just to give us a perspective of this is asset valuations versus interest rates. And if you'll look on the yellow line, going back to about 1980, so Gabriella, if you'll just mark that high point right up there, go straight up to the top of the graph there with your cursor, right in there. That right there is where we were in 1980. That's how high the actual, what we call our interest rates were. And some of you remember that are old enough to remember that are watching, in the US, our prime lending rate back then was about 18% in that time. And there were some rates from banks at that time that got as high as 21%. But now we're going to take the cursor and we're going to go from there. And so just follow that yellow line all the way down, if you would, with the cursor. And we're coming right down to the bottom there where it says 0.7. And this is approximately where the Fed rate was. The Fed rate got down to about 0.5, 0.3. It was right in those numbers. But I want everyone to notice that the yellow line is interest rates. And from 1980, they've come down all the way to where we were in the beginning of 2022. But look what happened to asset prices, which is the orange line. And if we take the orange line, come all the way back to the left, if you would, Gabriella, all the way back over here to 1974, go to 74, kind of bottom there, we had the oil embargo. And then you trace that orange line all the way up so everyone can see it on the screen. You see that asset prices increase based on pretty much where the interest rates were. Now, I'm not going to spend a lot of time here on this. I just want to say, and then I'm going to talk about the downturn. And if you notice that downturn there right at the end, this is you can see it's in 2022. You can see as interest rates went up in 2022, that the asset prices came down. So what it's showing you, there's a direct correlation, Chad, actually between what interest rates are doing. And then the other thing that's real important is we have just come out of so leave this one there, just leave it up for a second. We have just come out of a drastic money supply or stimulus. So we've had these low interest rates you see by the yellow line, and the stimulus, that means the amount of dollar bills that are printed that are actually put into the economy. We've had those two things, and that means a lot of dollar bills in the economy and money that is cheap. You can borrow money. It's made asset prices go up. And so one of the things we're going to see in 2023 is we're going to see asset prices, I believe, continue to come down as interest rates continue to go up. So let's take that one off the screen, if you would. Don't go to the next one, just leave it there. And so, Chad, right now, that's kind of the environment that we're in. And so we need to really talk to people about how to prepare themselves, you know, for what we're coming into.
Yeah, and you think about on your chart interest rates, and I love how we just jump straight in, like right off the bat, we're looking at this chart. So y'all buckle up. We got a lot to cover here, but even thinking about the Federal Reserve in the United States, they're really the most powerful monetary policy setting group.
Absolutely.
Supposed to be the smartest bankers in the world, they say.
Right.
So in the US, we have an individual named Jerome Powell who's running the bank. And what do you see, Billy, when we look at that chart for 23? You know, the Fed just raised rates here this last week, 0.5 percentage point. We think inflation's still around. I mean, what are you seeing as far as how many more increases in the rates, which would correlate with that chart? What are we looking at for next year?
The last time I went elk hunting was about 20 years ago. And I remember we had shot an elk and we were bringing it down the mountain on horseback. And I was on a big Belgian mare, large horse, and there was another rider who wasn't with our group that came up over the hill and was riding pretty fast, and it scared my mare. And my Belgian mare started running down the hill, and I'm holding on to the reins. I'm pulling back with everything I've got. And it took me, without any exaggeration, it took me a half a mile before I could get that mare even slowed down. She didn't stop, just to get her slowed down where I didn't think I was going to fall off. That's the picture of what the Fed feels like, where the Jerome Powell and the Feds feel like where they are. They're holding on to this Belgian mare, which is inflation, and they're trying to keep it. It got away from them.
Oh,
and what happened was, if they would have dealt with it about a year before they did and start bumping up rates just a little bit, it would have slowed things down. And so what's happened is I want everybody to hear this. If there's any economic indicator that they're afraid of, it's inflation. Because inflation is like that mare running down that mountain. I mean, to pull the reins back and to get it stopped. So I believe, they gave an indication by only going up 0.5% instead of 0.75% that they're sick, because that inflation indicator came back at about 7.7, 7.6, as opposed to in that 8.5%, 8.2% range. And so what happened is that I think that mare's still running on them, and they're going to continue to raise rates until they see it. And just so everybody understands, they've got that 2% in the back of their mind.
We're a long way from that.
We're a long way from 2. So the 2% that they have in their mind is that they want to see inflation come down to 2%. So they want to try to manage it. So what I want everybody to hear today, I didn't even get to talk about this yesterday with Lance on the podcast. We didn't have time. But one of the things that is huge that needs to happen here is we have to realize that they're going to pull that inflation down to about 2%. So that means they're going to bump rates or raise rates probably into 2024 until we start seeing inflation start coming down. And we'll talk about what's going to happen in 2023 specifically, but I can tell you one thing that's going to happen. They're going to continue to raise those rates until inflation starts getting down in that 3 to 4% range. And then we'll start seeing it get a lot softer. Now, what that means is that things like housing, assets like housing, and assets like even the stock market we'll talk about, what will happen is those assets are going to come down. So I do not agree with those right now that are saying that, they see the market rallying in
Soft landing.
2023. Yes,
Soft
I
landing
do not
period.
agree with
Yeah.
that because they're gonna manage it down to about 2%. So that's where we are right now. And so that's going to affect housing, which we'll talk specifically about when we talk about this. We'll also talk specifically about the stock market, that what's going to happen is I believe the stock market will go down another 20%. But before we start seeing it level out, and I think we're going to see something similar in housing, and in some markets, it's going to be even worse.
More than 20%.
More than 20%, because those markets that skyrocketed, we had a lot that did, right? But we had some even more than others, and the ones that did more than others, they're going to come down. And I don't think the lack of housing supply is going to save us. It might keep it from being as drastic as it would have been, but it's still going to be reasonably drastic.
Well, I think to that point, Billy, I know you may have a couple more charts for us, but Karen and I were on a Wealth Builders podcast recently, and I was sharing this story about historically inflation, like the 1940s after World War II,
Right.
Inflation went up, it came back down, it went back up. So I call it the double dip.
That's correct.
So we're really of the opinion at Wealth Builders Investments that there will be a double dip inflation. And even your chart that you just showed, you could see in the 70s, oil embargo, a lot going on with gold. Inflation went up, it came down, and it went right back up.
That's right.
So I think, we're of the opinion that what Wall Street and the media are saying, hey, it's a soft landing and, it's an all clear to go back in the water. I think that's a head fake.
Yeah.
And I think even inflation at 7-8%, it's going to come down, but I actually think we're going to see it spike back up if history is any precedence.
Right. And that's why the Fed's holding on to those reins,
Right.
because they know that. So they know that mare is running down the
Right.
mountain. That horse is taking off down the mountain, and they're trying to hold the reins. And that's the biggest thing they're afraid of is that, it's kind of like you get, some people talk about a rebound sickness, you come back and you rebound into sickness. Well, you get rebound inflation.
Right.
And if you haven't really corrected it, it's a big challenge. So here's the thing, when these kind of things happen in the economy, we hear the wealth of the wicked laid up for the righteous in the book of Proverbs. Well, what we find is that the righteous need to know what to be doing during these times in order to be able to understand how to handle it. So, and we're going to talk about, some of the strategies that we believe in about where you need to be.
Yeah, absolutely. Do we want to do another chart or?
Yeah, so I've got another one here that looks a little, the look of it is different, same color, kind of same color lines and stuff. And it's the next chart, and we're going to pop that one up real quick. And this is what I want everybody to see, because in some ways this has actually been the most alarming. So the yellow line is actually asset prices. And what we're showing you here is that this is housing and stock values combined, Chad.
Okay.
So basically we're looking at housing and stock, right? So, and you can see the yellow line, how that they have gone up. You can see that. Then you see where it's coming down. You see where asset prices have come down. That's because interest rates, right, have gone up. But the blue line is really important because, and let me explain that kind of the blue line. What the blue line is, that is called our gross domestic product.
Mhm.
And the way you think of that is just what your personal household income would be, right? And so if you say, okay, my personal household income is just say, for a round number for me to calculate in my head, let's just say it's 100,000 a year for household income. And and I know there's some that are watching, it's a lot more, some that are watching, it's a lot less, right? But just to say it's 100,000. And so, what we say is good financial stewardship is somewhere between about 28%, right, to 35% of your household income you could afford to buy a house. Okay, so for example, your house, if you took that, that represents what, about 8,500 a month. So that means you could afford about 30% of that, which is about 3,000 a month to be able to buy a house. Got, 2,500 to 3,000 a month. Well, so people understand that, right? I mean, you got a certain percentage you can afford for housing. What I want everybody to see is that our gross domestic product, the good news is it's gone up, except for the dip for COVID, where you see that little dip there, right there, that was COVID. And so our GDP came down, right? And so did other people, many other people's household income came down during that time. Now some, because of the stimulus, they were still able to get paid, right? But the point is, it went down, but then it came back up. But look, that's a relatively flat line, the blue line, compared to the yellow line. And all it shows you is how overpriced that assets have become, including the stock market. Because when we're looking at that, you can kind of see that it's going to take a whole lot higher percentage of your household income to buy assets, right? So now that interest rates have gone up, it automatically means house prices are going to come down. And I want everybody to hear this statement. We are not going to see it in housing, and we're not going to see it in the stock market until the psychology changes. And I'm telling you, the psychology will change overnight. Right now, there's almost an immunity, it seems like, from a mindset standpoint, where people really understanding. We still have the bulls out there in the stock market that say the market's going to rebound in 2023. If it does rebound, meaning it has some, those are all bear rallies. What we're seeing, right, it's all a bear rally. It's not a true bull trend, a new trend that has started. It's just a short-term increase. It's the same way with housing right now. With housing's come down in some markets, and they're staying on the housing right now. Like a single family property is staying on the market a lot longer than it has before. I mean, we were down to 24 hours in some markets, and today some of those markets are starting to edge towards 6 months. I mean, it's crazy. And even here, we're sitting right here in Denver right now. That the market here has edged to 3 to 4 months, and it was so hot that there for a while it was 24 hours to 1 minute. I mean, houses were selling. So I'm wanting everyone to understand that it's really important to understand that we're talking about actual hard number economic indicators. But until the psychology, you go ahead and take that off, Gabriella. Until the psychology changes of what people believe is happening, then when that psychology changes, everybody wakes up and realizes, oh, this is really happening. That's when it's going to be an opportunity to buy, right? And that's also an opportunity when I like to call it when there's blood in the streets in the stock market and in the housing market. That's the best time to buy. Now that goes against the normal psychology, very counterintuitive.
Well, that's what the great Warren Buffett says, is you want to invest when others are fearful and sell when others are greedy.
That's correct.
And really these charts, one of the things we talk about in our WealthBuilders coaching programs is this is an example of financial gravity, right? It's just what goes up comes down. Right. And at some point you have to take the punch bowl out of the party, as we say. And I think a lot of people were, filming this a week before Christmas. And I think a lot of people at the end of the year, they're not paying attention to what's really going on in the economy. They're getting ready to take time off. They're using their vacation. They're getting ready for Christmas, and rightfully so. But I think, and we've talked about this offline, but I think we get into January and then the reality of this sets in that, the economy is not as healthy. And remember, the economy is in the US is 2/3 what you and I spend. So consumer spending makes up 2/3 of that lower line.
That's correct.
What you're calling GDP. So, the market is up today as we're filming this on hopes that earnings are not as bad from companies like Nike and Best Buy and Walmart. And, we'll see if that holds true, but, the Fed meets again in February, so they don't meet in January. So we've got a little bit of runway time between now and February, and that's going to be, I think, a major indicator for what 2023 looks like.
Well, it is. And let me just comment, because what happens is if consumer spending is up, right? I want everybody to hear me say this. If consumer spending is up, then inflation will be up. What will happen is consumer spending will pull the cost of goods up. So if they think it's strong, so we have to be careful to understand that, we got to get at some point into a balance. So, again, that's a bare balance when people are anticipating that, for example, that consumer spending is up, and if consumer spending is up until we get the economy balanced, it's going to pull inflation with it.
Yeah.
And so that means because they're buying something, right?
Yeah.
And they're spending money. And of course, not all the money they're spending is on a real asset or a hard asset, but, or even a paper asset. So the point of that is we have to be careful. And I think that's what the Fed really would like to see consumer spending come down.
Right.
In order, and that's why they're raising rates, because the cost of money is more. And I'm telling you right now, businesses, large corporations are cutting back right now. They're cutting back on employees. They're cutting back on their cost of goods, all kinds of things they're looking at right now to try to save money as we go into 2023. And so we need to learn from them as well, that they're self-prophesying themselves into where they see, so the psychology there has changed.
Yeah,
but
even a lot of CEOs are coming out saying, hey, we're cutting back, whether it's the big banks and even some of the big online retailers, e-commerce, are saying, hey, we're not seeing things looking too rosy. Let's talk a little bit about recession, Billy, and just, you've shown these charts, and obviously this has some, I call it financial gravity, but it's going to have an impact. And I want to talk a little bit about bonds and just recession and what that means for our viewers. We have this concept called the yield curve, right? Where interest rates, so if I loan you money, you'll pay me a certain interest rate. And, the further out I commit that money, say 10 years, and the 10-year bond is what is most often referenced for mortgages. So
that's correct.
You got a lot of people buying investment real estate, but right now the yield curve is inverted.
Yeah.
So this will be a little technical, but talk about the recession potential and how severe it could be, because right now, every time the yield curve in bonds has inverted, which means if I loan you money, you can get more money on a 2-year bond than you can on a 10-year. And actually it should be the opposite. So this is, talk about that a little bit, because a lot of viewers that we talk to at WealthBuilders Investments, they're wanting to know how to invest their assets, how to move things around in light of the recession that we really feel is coming and could be severe.
Well, I think that where we are, when you get to that and build that inverted yield curve, that really what happens is, so everybody understands, is that if let's say you have a 10-year bond, right? And because interest rates have been low, the yield, or the interest on those that they're paying on those actually was a lot lower, right? So the yield was, say, just a round number. So the yield was, say, 2.5%, okay? And or the interest rate they were paying was 2.5%. It means, though, that when the new bonds, for example, go up in value, then like the 2-year has done because of these interest rates, it actually makes the other bonds go down because they're not paying as much. So the actual value of the bond goes down. And so for example, if you took the bond to sell it on the market, the actual bond that you were already holding, that the market is going to pay you less for that. Right. And so because it's yielding less than the other bonds. So what happens is that 10-year now has actually lower than the 2-year, because the 2-year is actually reflecting the more current rates. And so people say, well, what does that mean? What that could mean, I'm not saying it will mean this, but it could mean that the bond market itself, depending on where we go, could actually crash. I mean, there is a issue with the bond, and if that were to happen, it would have a reverberation similar to what happened with mortgage-backed securities and
Yeah.
collateralized debt obligations that we had in 08. Now, I honestly don't think that the bond market is going to crash, because I think they're going to kind of keep it up and kind of prop it up the best they can. But right now, that is one possibility that can happen with where interest rates are going, because the way the Fed is raising the funds rate right now, it directly affects all the interest rates,
Right.
including the ones on new bonds that are being issued, which makes all these bonds that were out there before that actually go down in value. So that's the kind of thing that happens. Now, I know, I agree, it's a little technical, I think when we start talking about that, but just to let people know. And so I'm telling you, when the psychology changes, right? When it goes from Wall Street, the psychology goes, for example, from Wall Street or corporate America to Main Street, and the psychology changes at Main Street, you're going to see some of these things we're talking about in 2023. Now, here's the good news. We don't have to be negative or down and out, because we know if God be for us, who can be against us.
Right.
But we also have to understand we have to use wisdom in these times, and to know what to do with our money and what to do with our, for example, with what we're going to invest in as far as assets.
Yeah, and I want to transition a little bit to talk about what assets we like for this coming year. You and I have talked offline about it. There's different asset categories. Solomon in Ecclesiastes says invest in 7 or 8 things, for you know not what will come upon the world. And so one of the things we're big believers in at Wealth Builders Investments is we want to put our eggs in different baskets. And we don't want you to follow the traditional Wall Street advice for a couple of reasons. One, most of Wall Street is woke. And so we don't want you, and now we could spend a whole session on that. So I got to hold Billy back in that one. Or we might go an extra hour, Karen. But the traditional Wall Street advice, and then I want you to weigh in on what are some asset classes we like for 23, just so viewers can understand where should they be positioning, because we do think there's opportunities in the midst of chaos. There's always opportunities.
Absolutely.
And so we want to be clear, we're not doomsayers here, but one of the things we want to encourage you on is, okay, here's what's going on in the environment. So how do I be shrewd in where I put my money? Now, let me give you one bit of warning is Wall Street, traditional financial advisors are going to tell you what, Billy, buy and hold, stay in for the long term, put it in a 60-40 model of stocks and bonds. And, Billy, I've probably met with half a dozen people just this week alone who have come in through our platform, through the different shows, and looking at how they're invested. And I asked them, well, what is your advisor telling you?
Yeah.
And it's exactly what I just said.
It's 60-40 and write it out.
And so do you as a viewer want to write it down 20-30%, or would you rather invest in different assets where you can take advantage of these things? So we do a lot with Wealth Builders coaching with real estate and business, even talking about intellectual property, passive income. What do you see as some key asset classes for the new year?
Well, I can tell you what the big money's doing.
What's big money doing, Billy?
Big money is buying farmland. They're buying farmland and art. High-end art they're buying. But for the normal investor, as a matter of fact, I was just talking to somebody this past week about farmland again.
Sure.
And so because farmland is not going to go down, right? Farmland traditionally has given what we call a lower yield every year, but it has appreciated like crazy.
Only so much farmland out there.
You got it. Only so much land. They're not making any more, as they say. So one of the things for the average investor, if we want to look at safety, for example, so you've got cash itself. Of course, inflation eats cash. So if you have an 8% inflation rate and you have $100, that means at the end of the year, if it's at 8% for the year,
Right.
Well, then at the end of the year, you only have $92, right? And so you just lost 8%. So so one of the things we talk about, of course, to start off is precious metals, gold and silver during uncertain times is always a good place to go. And other kind of hard assets, for example, like land that we talk about. And then I'll come back to a couple of these, but I want to say something about crypto. I've been talking about crypto for 2 years. and telling people that it has no intrinsic value. I've said it on publicly all over the place. And look what's happening right now in the crypto market, right? Now, I want to tell you, I think that there are some parts with crypto and with blockchain that are going to be here long term. And there are some, I believe there's actually some cryptocurrencies that are going to actually last and come back. But right now, the way that crypto is and until some of this technology gets more adopted by even central banks, what we're going to find is crypto has really no intrinsic value. So some people say, I'm going to invest in crypto. Most of you that are tuning into this webinar, that are part of this webinar, you probably already know by now some of the effects that we are seeing that has happened with crypto. So I don't talk about that. So precious metals. And then I think that once the psychology changes, right, and I may come back to a couple other things, but once the psychology changes and we start seeing these dips in prices, which will include the stock market, but right now I'm specifically referring to real estate, I think that it would be a good time to buy. In other words, it's a good time to start investing. And so one of the things we want to do here in our office, Chad, is I want to bet, and I tell Karen this, I want to put out some emails and things on different markets when we start seeing what we think are good opportunities for purchase. In other words, we're going to let people know what we're thinking, and that's totally free. We don't get anything out of that if you go buy a piece of real estate at all. But we'll also tell you that on the stock market as well, because there is going to come a time here in the near future. Probably it may be when I say near future, it may be 2 years from now, but there's going to be a time somewhere between 12 and 24 months, maybe as long as 36, when it's going to be a good time to jump back into the stock market. I think with real estate, we're going to see it in hopefully in about 12 months, where we're going to have some real strong indicators that the psychology has changed and the prices are coming down. And I think I had some other graphs, don't put those up right now, Gabriella, but I had one I didn't put in this set of graphs, so I apologize. But it shows how much the interest rate has gone up on mortgages and then the effect on prices. Well, what's happened is because we've had such a low supply of housing, that how much the interest rates have gone up, even though it's a lot. For example, for somebody buying a $500,000 house, in some cases, they're paying like $2,000 more a month, depending on the loan that they get. I mean, it's crazy. And but what's going to happen is with the interest rates, are going to go up even more. So that $500,000 house, 20% drop will drop it down to 400,000. And so that's the kind of stuff that as we start seeing this happen, then there'll be an opportunity. And then at some point out here, 3, 4, 5 years, interest rates will come back down, start not down to, to 2% or 2.5% for mortgages, but probably somewhere in that 4.5%, 5%, maybe even 5.5%, right? Somewhere in there, they may come and settle back in there, and then you can refi that real estate that you got for 20% or 30% off. And so those are the kind, you just have to think correctly. And the big hitters, right? Those that invest a lot, that's exactly how they think. They understand I'm buying the asset low, even if I'm using borrowed money and it's costing more right now, I'm getting that asset for a much cheaper price. And I don't, and my window that I have to stay in it with high interest is going to be just short, and I'll be able to refi back to a lower interest rate. So there's some strategy. That's only one strategy, right? There's other strategies that we, and I'm specifically talking about in real estate. It's the same thing with the stock market. I love to see the market come down in that 3,400 level for the S&P, and I'll feel like that at that time would be a good time. I'm going to start buying at that point. Right. I'm going to start jumping back in a little bit more aggressively.
Yeah, I mean, you look at the stock market and, the S&P 500 is the largest U.S. index. It's a good barometer for what's going on. It's today sitting at 3,800, 3,879 before we came on. So it appears to have a lot of resistance at 4,000.
That's right.
So when Billy says 3,400, just understand that, we wouldn't recommend to be putting a lot in stocks right now because it's at that higher end. And what we're doing at WBI, Wealth Builders Investments, is we're actually putting a lot of money in short-term right now, short-term cash management, getting a plan together. Hard assets, just to kind of interpret what you said, hard assets is what we like, different types of real estate, gold and silver. Interestingly, gold, I know a lot of people are just putting tons of money in gold, which we invest in personally and as a firm. And you can clarify this, Billy, but gold doesn't generally take off in price until interest rates level out.
That's correct.
Because gold does not pay a dividend.
That's correct.
So it's a great store of value for those of you interested in, well, what's our thoughts on gold and silver? We like it, but just remember, gold's it's around 1830 this morning per ounce for gold. Silver's at 24. I think personally that those gold and silver prices will take off.
Yeah, they will.
Once the Fed takes their foot off this raising rates.
Yeah.
Do you agree with that?
Oh, I do. And because what's going to happen is when that psychology changes, right? And everybody goes, oh man, this is not good. When that happens, gold and silver are going to go straight up. I mean, they're going to climb. And so, I think to kind of emphasize what you said is that gold and silver, when people ask me about that, I always tell them, you got to remember, you don't get the dividend, or you're not making the only way you ever make money off of gold or silver, if you're trying to make money, right, is you have to sell it in order to get the return. Whereas assets like dividend paying stocks or rent from real estate, those actually pay you while you own them, right? And for example, your real estate can go down in actual value, like that $500,000 house could actually go down to 400. However, the rent in that case will more than likely go up. And so it's kind of interesting. So all of a sudden my return, even though it's gone down in value, my return is still going up on what I originally paid. And so you have to think different to understand how to position yourself. And most people are only thinking about how the asset goes up or down, and they're not thinking about how the asset pays them.
Well, and as we talk about at Wealth Builders, an asset is something that puts money in your pocket.
That's correct.
Or mailbox money.
Mailbox money, it's either monthly, quarterly, or annually. And if it's longer than annually, then that's more your long-term horizon for investing. But remember, when we teach on the law of income, there's a reason we teach that, is because we want people to think monthly, quarterly, and annually. Not that it's wrong, Chad, as we both know, it's not wrong to think long-term, but what happens is you have to discipline yourself more with your investments and make sure that when you invest that you're actually getting income from what you're investing in. And that's the reason we teach the law of income. It's not about waiting 30 years from now, even though there's nothing wrong with having a long-term horizon for your financial planning. But the law of income is a critical thing that people need to discipline themselves in, especially in this time we're living in right now.
Yeah. Well, this has been really powerful. We're going to have to do a part 2 economic outlook at the rate we're going. I know we're going to shift to questions here in a little bit. And you and I had the opportunity to record some new teachings recently called Investment Mastery, which I know Karen will share about. But you talk a lot about this XXX concept, and no matter where you are as a listener and viewer, if you're starting out 1X, you're trying to get financial freedom,
right,
or you're getting to financial prosperity, the 2X or the 3X, you're really becoming a kingdom investor. And I'm excited about that investment mastery product, which we'll share with you how to get that. And then, we also do a lot of the conferences and coaching. So I know we've gone fast pace here. I wanted to share one more thing before we jump to Q&A. And if you have something else you want to add, Billy. One of the things that Wealth Builders Investments that Billy and I have created is, we're a full service wealth management firm. So if you have questions as a follow-up to this on, okay, this was great, a little over my head, or I got it, what do I do? And what I love about Wealth Builders, Billy, is you give people such practical hands-on tools, whether it's the books or the conferences of here's the formula on how to invest in real estate. Here's formulas on how to start a business or create intellectual capital. So we have at Wealth Builders Investments what we call a rising dividend strategy, which was one of the things you and I came up with early on a couple of years ago. So if you're looking for, okay, how do I invest my resources in the economic environment we're in, and I want to create this passive income. We have a very specific strategy we've created. And although not the focus of today's call, one of the things we're really waving the flag on is pro values investing.
Absolutely.
And, you want to steer clear of the economic recession, which we think is going to create a lot of chaos, but we want you to be empowered as believers to not have your money in woke companies.
Absolutely.
And so we call it pro values.
Pro values, biblically responsible and kingdom impact type investing. But pro values is a big deal because a lot of people, sometimes they just, they're thinking about being biblically responsible, which is important, but they don't realize that you not only should be avoiding, for example, companies that are woke, but you also should be investing in companies that are not woke. In other words, those that are actually in alignment with your values. And we have a whole list of
There's
them.
actually companies out there, Billy,
there
because the
are.
media doesn't say that.
No.
There are actually companies that are pro First Amendment, Second Amendment.
They're definitely pro First Amendment. They're definitely pro Second Amendment.
Well, praise
And
God, they're out there.
Yeah, they're out there. And we've identified them. And really, Chad has done a phenomenal research. And actually, we've paid for that research. You've done it, but I mean, we've gone out and asked, actually spent quite a bit of money really researching and finding what those companies are. And so it's pretty proprietary, Chad, what Wealth Builder Investments has come up with under your leadership to be able to get to that point of being able to find those companies. So that's really important information.
Yeah. So we do have a pro values index that we would like to make available to you if you don't already have it. So you can visit wealthbuilders.net/invest. And we'd love to hear from you, get your feedback, and also send you that pro values index. And it's got the top 30 companies to avoid for 2022 and the top 30 companies to promote, which are pro values. And then we're working on our 2023 one. We're going to do another podcast show. We'll announce that. We'll have some new companies on there that are in the news that are just have gone overboard on the woke and cancel culture, and some that we're really positive on. So we'd love to get that in your hands. Again, that's wealthbuilders.net/invest. And then anything else we want to share before we jump into Q&A?
No, I think that's good. I want to just echo what you said, that wealthbuilders.net/invest. We've got a lot of great information on there that people can find out. But I think right now we may go to Karen and see what she's got.
Wow, great job, you guys. And I have really good news for all of you. If you are registered for this webinar and you got the Zoom link, we're going to be sending you that Pro Values Index completely free, along with a video recording of this session. So look forward to that. And also, hey guys, I was thinking, this information is so good and we're getting as much in this period of time of an hour as we can. But really, if people want to learn more about this and really immerse themselves in the business, investments, and real estate, we've got a Wealth Builders Conference, which is our biggest conference of the year that is coming up February 17th through the 19th. And we've still got tickets available. You can join us in person, which is an amazing experience to be in a room with all of us. We get to talk to you and spend time with you, and then other believers that are just hearing this sound in the spirit that Billy talks about. And so to register for that, go to wealthbuilders.org/events. Again, that's wealthbuilders.org/events. And then the product that Chad was mentioning, we've got 3 products, which is the 1X, 2X, and 3X, which, we all are, some of us are working on getting out of debt. Others of us have got some good passive income going, and we want to get to that 3X. And then there's some of you out there that are in what Billy calls a 3X, and you are stewarding, or what we call ministry of finance, wanting to invest and to bless the kingdom of God and help grow it. So those products will be on that email as well. You guys, I thought it might be kind of fun too. We've got people on from all over the world, and I'm just going to give a few shout outs here. We've got Carolyn on from Kenya. Kim is on from Wisconsin, Don from Colorado Springs, Watson from England, We've got Jamie from Wisconsin, Trina from Kentucky, Glenn from Vancouver, William from Southern California, Sonia from Switzerland. We've got Carmen from Germany, Asabi from Ohio. We've got Susan from South Africa, Zita from South Africa, Innocentia from South Africa. We've got Judy from Oregon, people from Texas. We've got Montreal and Toronto, Canada, that are on with us. And we've got someone on from New Zealand. And so we're just so grateful for all of you that are joining us really from all over the world and just part of this Wealth Builders family that Billy and Becky have put together that we're also blessed to be a part of. So we've got lots of questions and we're going to get started. And the first one is from Fern Watson. Fern, thank you so much for being a part of this. And Fern says, good afternoon. You said in an earlier message that inflation will go down, but will go back up again. What does this mean for us as an investor, and how do we make this knowledge work for us?
Yeah, I mean, I think I do expect a double dip inflation. And so we call it a head fake. And so I think a lot of people right now, the media in the US is saying inflation's coming down, all is well. And so you have to be careful not to have all your money in stocks and bonds right now. And even on the real estate side, real estate's subjective to where it is. So you can find opportunities in real estate. It's a little different than stocks and bonds, but I would just say you need to be very cautious and have a diversified approach with your money, and don't buy into what the media is saying that, hey, it's all clear and it's a quote soft landing, because we really think we get further into 23 that that's going to lead into what Billy said earlier about, a 20% decline in the stock market, which is the biggest indicator for the overall economy.
Yeah, and I think true. In addition to that, there were many of you may have, or some of you may have seen some of the movies that came out after the crisis in 2008. One of those was called The Big Short. The movie was called The Big Short. And the very people that they did the movie about are those very folk right now are talking about the similarity. Now they're saying it won't be as bad as 08, but the similarities of what's happening are very similar, even when they look at the bond market itself. And so the point that Chad's making is that head fake, right? If you look at people that really called the 08 thing correctly, they're saying something very similar to the way we're describing it. But now you have other people, for example, that are supposed to be financial experts, and that are actually saying that it is going to be a soft landing, and we are, and then we're going to turn around and go back up. So we just don't believe among ourselves that that's going to happen. And so you want to position yourself, meaning at some point it's going to come back, but not in the time frame they're talking about. Yeah. And we're gonna tell you when it's a good time, right? That we think that it's a good time to buy. That'll be free. That doesn't cost anything. We'll come on the webinars and tell you what we think. But right now, that I agree with Chad that there's a big possibility of a head fake, and that just means that inflation is going to come down and the Fed's going to get positive, and all the other economic folk are going to be excited about it, and then boom, we come back and stuff gets out of hand again, and they have to start reeling it in. So that's what we mean by that.
Yeah, exactly.
Great, thank you so much. We've got a couple questions here on gold and silver, one from Judy and one from James. And you did talk about that. You mentioned what you thought was going to happen with gold and the price of gold. And James' question is specifically, what's the best place and or way to purchase gold?
Well, there's several ways to purchase it. My personal favorite, of course, is to actually own the metal itself. That means that you find a gold dealer. Now you have to realize that when you're purchasing gold, right, you're going to pay what we call spot price, what the spot price is, plus they're going to charge you some kind of fee to be able to do it. And then depending on what kind of gold you purchase, such as if you were just, for example, to just purchase bullion, or if you purchase some of the coins like, say, American Golden Eagles, for example, You can, South African Krugerrands, Canadian maple leaves. And so the point of that is that there's a little cost that's associated when you actually purchase the coins. Then we have another way, Chad, we have a couple of other ways. And one of those is you can purchase the gold and it can be stored for you.
Offsite.
Offsite,
Third party.
where a third party is actually sheltering it. And instead of you holding it yourself. And then the other way is through ETFs and other things that are, one is GLD, for example, as an ETF, but there's other ways they can get gold exposure.
Yeah.
But we personally like the metal.
Physical.
The physical metal. Now,
yeah.
I do have a smaller portfolio that I use people call it diversified, and I call it a non-correlated portfolio, where I have about 10% of that portfolio in GLD. But and I just keep it there. I just kind of ride that out. And I just keep it there at 10%, but I own a lot of physical gold.
Yeah, you can contact us directly, and we can, obviously you can find local dealers in your community.
And you need to find local reputable dealers in your local community. You can look it up and Google it.
Right. And then we have sources if you really want a third party gold dealer where they can store it offsite, like at a Brinks security facility. We can obviously help you with that. But I'd start in your local community on finding that.
Awesome. Thank you. Hey, Chad, if people do want to connect with you on purchasing gold, should they go to wealthbuilders.net/contact-us?
Yeah, that would be fine. Yes.
Okay, great. Awesome. All right. This is from Sonia, and she is in Switzerland. She says, good afternoon. I placed my entire money in bank investments in Switzerland. I already lost 20%. You said to expect a drop of 20%. Should I take the entire money and put it in a normal bank account? Thank you so much, she said.
Yeah, it must be. It sounds like in Switzerland, if she's lost 20%, she's got to be in some kind of investment account, what we would call over here a brokerage account. Yeah, and she must own some kind of equity stocks or own some kind of stocks in order to have that kind of drop right now, I think. So that's what we're thinking. And so I know Switzerland, just like Canada does, we may call it something different, but basically what we're saying to you is you don't want your investments to be in paper assets that have direct exposure to the stock market. And that includes the European stock market, the US stock market, or the UK, for example, stock market. You just have to be careful and come out of those what we call equity investments, and maybe go and find some kind of, to keep it simple and easy today, find some kind of cash accounts that are paying you, maybe 2% or something like that in those banks. And the other way to do it is you can do short-term, what we call over here, certificates of deposit. And in different countries, they call them something else, but that's where banks are paying you a specific interest rate. But my advice is do not lock in those what we call certificates of deposit for longer than about 12 months. I know some people that have been calling me that are doing 2 years, and I probably could live with 2 years, but you're just going to have to be careful because we don't know where rates are going to go.
Yeah, that's great, Billy. Thank you. This is from Brian Thomas. Hey, Brian, he's from the UK, living in Atlanta, Georgia. And his question is, what is the global relevance of this information? He recently did move from the UK to Georgia, and he's holding off buying another property in the UK. So he's currently holding cash in the bank. What do you suggest?
Well, whether we really like it or not, we're living in a global economy. And typically what happens in the larger economic nations, the US is the largest, affects all the other nations as well. And so typically assets of any kind typically look about the same, especially in the developed nations of the world. And one of the things that people need to realize is the cost of money is the cost of money, for example, anywhere in the world. And so now in developing countries, what you'll find most of the time, not just in other countries, but in developing countries, those whose economies haven't really, those developed, those interest rates will be much higher. The cost of money is much higher in developing nations. But in most Western nations and even developed Eastern nations, the cost of money stays very similar unless someone is artificially bringing it down or up, depending on, and right now, where the Fed is kind of artificially bringing it up, but it's not really artificial. What they're trying to do is match what inflation is doing. So in other words, they're trying to bring that inflation down. So basically, honestly, what happens in the US pretty much affects everywhere else in the world. And that includes price of assets, cost of assets, as well as the cost of money. And so.
Yeah, I would just add, just briefly, the recession will most likely start in Europe before the US. So it's going to hit, if it's a wave, it's going to hit the UK and develop Europe first. Now, we don't have time to talk about this, but the euro, the currency, is pretty level with the dollar right now. So I know some folks, because of that, your dollars can go further in Europe, and they're actually looking at real estate in some of these really nice European countries, and it's much more affordable. So that's just kind of a free thought there on what's going on here.
People have been buying in Spain and Portugal. So
well, that's exactly where these people are. They're buying in Portugal. Yeah.
And so that's happening a lot more because your dollar goes further.
Wow, that's great, you guys. We've got so many questions here. I'm going to try to get two more in. And then I just want to encourage everyone, Chad, I'm going to kind of put you on the spot, but how about if you and I do a podcast that will air, early part of January and follow up with the rest of some of these questions, just so people know that they can get their questions answered. Does that sound good?
That'd be great. And we're going to be launching a WBI podcast called Kingdom Finance, and that'll be starting in January. So maybe we just do that on one of those episodes, and we'll tackle all the Q&A. We want to empower you with answers.
Yes, just to encourage people that we will get to your questions.
Absolutely.
All right, this is from Andrew Birchfield, and he says, for someone who wants to begin their investment journey in 2023, where would you start? And then how do you feel about crowdsourced real estate investing sites like Fundrise?
Well, first of all, let me just say the place you start, when people always ask me, they say I have $1,000 to invest or 5,000 or 10,000. I always say invest in yourself. So one of the things that in answering like the question on what about those websites, I think those a lot of those websites on real estate are very helpful. You just have to be, I want to encourage Andrew to look at some of our formulas that we teach, which are free in our blogs. We have a lot of that information that's free. Plus we have a full-blown real estate course on Wealth Builder University that people can go on and get. They kind of give you some ratios to look at. So one of the things is you have to learn, Andrew, what you're doing and to understand, let me say it this way. You have to understand when to say no to investments. And it's very important. So if you can understand when to say no, then that empowers you of when to say yes. And so the truth is you have to get the knowledge, understanding, and wisdom to be able to do that. Now, it doesn't take that long to do it. And if you'll follow the formulas that we teach you and then tell you some of the pitfalls you need to avoid when in doing so, if you'll do that, then most of the time you'll come out really good in the kind of investments that you make. But there is a learning curve in all of this. And honestly, the reason that only somewhere between 1% and 2% of the population in the US ever reach a certain level of financial freedom is because it does take knowledge and understanding and wisdom to be able to get to learn what to do. There's a reason for that. And so, it's very difficult to drift to the top of the mountain. And I think what a lot of people do when it comes to investing, they end up majoring in minors, and you've got to learn to think properly, get the right mindset, and it'll help you when you start making investments.
Yeah, and I would just add, just briefly, I think the investment mastery product that we just recorded,
Oh,
we put
yeah.
together a ton of teachings. Karen, and even for Andrew, that might be the 1X. I think investing in yourself as we teach, starting with that product, spending time early in the morning, weekends, just really immersing yourself in it is going to help you on that path to wisdom.
I agree, Chad. So the product we just did, where we talked about the first X,
Right.
second X, and third X, to understand that, it gives you a 30,000-foot view of wealth building and how you have to think different. And on there, we talked about the laws of wealth, the different laws of wealth that are really important for you to have to exercise and move into in order to be able to build wealth.
Oh, that's great. Trev Henderson is in the UK and he's wondering how can he access Wealth Builders investments while living overseas? And we actually get that question a lot.
I'll take that one. So Wealth Builders Investments, we're a US based investment advisory firm, and we do have US laws specify which countries we can work with. The UK is a country we can work with. So we do have a online model. It's actually available through Charles Schwab. If you're in the UK, and if you're in other countries and you're watching, just send us a note and ask us if US law allows us to work with you in those countries, but where you can actually invest in our Pro Values models,
Yep.
Which we have online. So can definitely help you there for those in the UK and potentially other countries. Just reach out to us through wealthbuilders.net and we can answer that.
Awesome. Okay, just to recap, all of you that are signed up and watching this webinar, you are going to get a recording of this webinar. So feel free to share it with friends, watch it again. You're also going to get that free download of the Pro Values Index. And we'll give you information on how to register for the Wealth Builders Conference that's coming up February 17th through the 19th, and how to purchase the product that Billy and Chad were just talking about. Hey guys, I think I've got about 20 more questions. This is a really hot topic. And so I just want to share with everybody, some of you may not know this, we have a Wealth Builders podcast that is on every week. And you can access that on Spotify, Apple Podcasts, just Google Billy Epperhart or Wealth Builders Podcast. It's also on our YouTube channel. So if you search for Billy Epperhart on YouTube, you can go back and listen to all these podcasts. The one that Chad was referencing actually launched, the one we did was last week. And then I'm going to have Chad on the main Wealth Builders podcast again. And then as he mentioned, he's going to be launching one specifically for investment. So I think, as you can see, like we're dedicated, right? Billy and Chad, we want to get this information to you. So we just are providing every way possible to help all of you in your wealth building journey. So again, just want to thank all of you for being a part of this, for being in the Wealth Builders family. Billy and Chad, thank you so much for this amazing information that you shared with everybody today.
We're excited, Karen.
This was fun. Let's do it
was
again.
fun. We'll have to do it again.
We'll do it again. All right. Well, Merry Christmas, everybody. God bless you. And thank you for being a part of this webinar. Have an awesome rest of the day.